For the purpose of calculating annual interest, it might seem reasonable to assume that a year has 365 days. However, in practice, interest calculations don't always assume that this is the case. A year can have 365, 366, or even only 360 days. Moreover, individual months can contain more or fewer days than you might expect. Depending on the day count basis on which interest is calculated, the amount of interest is different for the given principal amount, interest period, and interest rate. There are two types of day count basis: money market basis and bond basis. In the last session, we reviewed the bond basis, so let's look at the money market basis in this session. Money market basis uses a day count fraction equal to the actual number of days of the investment period divided by 360. A key exception is the UK and also several other Commonwealth countries, where the denominator is either 365 or the actual number of days in the year. So the latter could be either 365 or 366, depending on whether it is a leap year or not. So money market basis is also called actual over 360 basis. Let's look at an example. If $1 million is invested at 10% for 1 year using money market basis, then the investor would receive the following interest payments. So the interest would be 1 million times the 10% times 365 over 360. So the result is 101,388. If we use the bond basis, which is 365 over 365, then the investor would have received US dollars 100K on a bond basis. It's clear that the calculation of interest using the money market basis method is more attractive for the investor than the bonds basis method. The annual interest under the money market equals to 10.1%. The term money market basis comes from the fact that the interest on many money market instruments is calculated according to the actual number of days, compared to the standard year of 360 days. Therefore, the terms money market basis and actual over 360 basis are often interchangeable. For the next session, we'll look at the link between bond basis and money market basis, and more importantly, how to compare investments which have different day counts and compounding methods.